The rand has briefly crashed to 16 rand 95 to the dollar.
On Monday, the South African rand faced some challenges, dropping below the 19 rand per dollar mark and hovering near its lowest point in a month. In the last month, it decreased by nearly 5% against the dollar. In layman's terms, this means that it takes more rand to buy $1 than it did before. The rand is currently trading around its weakest level in a month, which means it has lost value compared to the US dollar over the past month. In simpler terms, imagine that you have 10 rand and you want to buy something that costs $1. If the exchange rate is 10 rand, you would need to spend 20 rand to buy $1. Therefore, the higher the exchange rate, the weaker the rand is against the US dollar. The latest bout of weakness is not driven by South African factors. Instead, fear and uncertainty have gripped the market, which means investors are dumping riskier assets for the safety of the US dollar, says Schalk Louw, portfolio manager and strategist at PSG Wealth Old Oak. In May, the dollar-rand exchange rate surged to a record high of 19.9, marking a 15% increase over the preceding 12 months, starting from 15.9 and reaching 18.4 at the beginning of May 2023. The persistent depreciation of the South African rand has drawn considerable attention due to its multifaceted impact on the socio-economic landscape. The implications of a weakened currency for South Africa are subject to debate. While some argue it has advantages such as potentially boosting exports, there are notable drawbacks. A weaker currency tends to fuel inflation and heighten volatility. Increased volatility can be disruptive for businesses, impacting stability. The bottom line here is that a weaker rand has a tangible impact on everyone, making us feel economically less well off. This effect is particularly pronounced for the less affluent, as soaring inflation leads to higher interest rates, further affecting those with limited financial resources.
South Africa is a failed country. It is a lawless country. It's a country with an extraordinarily high rate of violent crime, and it's a country with deep racial divisions and problems that we wish had disappeared because we all love Mandela, but that's not the reality.
Well, whatever the reason is, and it's very difficult to determine how the rand behaves, but having said that, the rand has weakened to its lowest point on the intraday movements. And again, it just adds fuel to the fire. I mean, we had the Reserve Bank governor tell us that the weak currency is one of the reasons, over and above load shedding, over and above global circumstances, that we have inflation so high, and high inflation is why they react so aggressively.
The depreciation of a currency is a complex phenomenon influenced by a myriad of economic variables. In the case of the South African rand, several factors contribute to its decline. One crucial aspect is the country's economic fundamentals, including trade balances, fiscal policies, and interest rates. Additionally, global economic conditions and geopolitical uncertainties play a pivotal role in shaping the currency valuation. For instance, external shocks such as fluctuating commodity prices, particularly in the context of South Africa's reliance on commodities, can significantly impact the rand's value.
2020 is now the deadliest year in US history.
In December 2019, COVID-19 started spreading throughout China, reaching the rest of the world in 2020. In response to managing hospital capacity, global lockdowns were imposed, with South Africa imposing among the strictest. This created significant strain on the fiscus, with unemployment in SA soaring to 33%. Many negativities have been stacking up against South Africa. The economic outlook appears dismal, with increased load shedding, rising interest rates, and failing infrastructure.
Let's continue the bulletin here. A new report by the Council for Scientific and Industrial Research Energy Centre has analysed South Africa's load shedding, indicating it cost the country's economy between 60 billion rand and 120 billion rand in 2019 alone. The total economic impact of load shedding in South Africa could be as high as 358 billion rand. That's just over the past 10 years. Well,
to add fuel to the fire, South Africa's impartial stance on the Ukraine and Russia war and its invitation to Putin to visit South Africa has been threatening our relations with our biggest trading partners, Europe and the USA. Now, on the other hand, the banks are manipulating the rand and thus affecting it to the latter. As we speak, even the ANC wants criminal charges on banks for rand manipulation.
The value of the rand fell this week, at least in part due to tension between Russia and the Ukraine. Meanwhile, the US Federal Reserve is having a policy meeting which often affects global markets. And closer to home, analysts expect the Reserve Bank to increase interest rates on Thursday. But why does Ukraine's fate affect a faraway economy like ours?
The South African rand has been experiencing a decline in value against the US dollar and other major currencies. The reasons behind this decline are multifaceted and complex but can be attributed to a number of factors. Firstly, the value of a currency is determined by the market forces of supply and demand. In the case of the rand, its current weakness can be attributed to a myriad of structural problems facing the local economy. The main determinants of a currency value include demand for a country's goods and services, which is closely linked to the growth and national income of its main trading partners. Equally important is the domestic interest rate. If it is high, it is likely to attract foreign capital, causing the exchange rate to strengthen, but high inflation can wipe out the benefit of high interest rates to foreign investors. Factors serve to drive the currency down. These include a current account deficit, which gets bigger when a country spends more on foreign trade than it is earning and has to borrow capital from foreign sources to make up the difference. This implies that the country requires more foreign currency than it is getting through sales of exports, and it supplies more of its own currency than foreign demands for its products. This excess demand for foreign currency leads to depreciation in value of a currency.
A country's currency is affected by the overall flow of goods and services into and out of a country. Exchange rates often affect a country's balance of trade, which is the relationship between the value of its exports and the value of its imports. If a country exports more goods and services than it imports, it has a trade surplus. If a country imports more goods and services than it exports, it has a trade deficit.
Factors such as political instability and poor economic performance can reduce investor confidence. This inevitably forces foreign investors to seek out stable countries with strong economic performance. Thus, a country that is perceived to have positive attributes will attract more investment away from the countries perceived to have more political and economic risk. The decline in the value of the rand has a significant impact on the middle class and the poor. As the value of the rand decreases, the cost of imported goods increases, leading to a high prices for consumers. This can lead to inflation, which erodes the purchasing power of the middle class and the poor. In addition, the decline in the value of the rand can lead to a higher interest rates, which can make it more difficult for individuals to borrow money. To protect themselves from inflation, individuals can take a number of steps. The first option is to invest in assets that are likely to appreciate in value over time, such as stocks, bonds, or real estate. Another option is to invest in commodities such as gold or silver, which tends to hold their value during the times of inflation. And it is always important to maintain a diversified portfolio, which can help mitigate risk. So, where to for the rand? In the short term, a year, the rand has always been very difficult to forecast due to the mix of global flows and local sentiment, but over the long term, 5 years plus, we believe that the rand will continue to weaken due to SA's weak economic outlook, its rising debt and unstable political environment. Therefore, barring any other unforeseen event, we believe the rand is likely to strengthen over the short term, but in 5 years, we expect the rand to be materially weaker than the current levels.